Hi everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business for you. And let's just say for Boral acquisition. Corp, their latest report is a bit of a treasure hunt for an IPO story. Buckle up. This is Boral acquisition, Corp's quarterly report, basically their financial checkup for the period ending June 30th, 2025. Imagine a brand new company just getting its bearings, and that's pretty much what we're looking at here. They're a blank check company, also known as a special purpose acquisition company or SPAC. Their whole game plan is to find another company to merge with, essentially helping that company go public without the usual lengthy process. So what are they up to? Well, before a merger happens, they're mostly busy organizing and getting ready for a big public offering. This report shows us their financial snapshot as they were gearing up for that. Looking at their assets on June 30th, 2025, they had a modest $25,000 in cash and another $1,734 in deferred offering costs. These costs are like the expenses you pay up front before a big event like an IPO. Think legal fees and filings. So total assets were just under $200,000. On the other side of the ledger, their liabilities were mainly a promissory note to a related party for about $461. This is essentially a loan. And then there's something called a shareholder deficit. Don't let the fancy name scare you. It just means that at this very early stage, their liabilities outweighed their assets, and they had $264.20 in the negative. This is pretty typical for a company before it's actually doing any real business. In terms of their profits and losses, as expected, before any business operations, they reported a net loss for the quarter. For the 3 months ending June 30th, 2025, that loss was $36,000. And for the short period since their creation, it was $41,420. This loss primarily represents their formation and operating costs. Now let's talk about who owns what. The company issued a significant chunk of its Class B ordinary shares to its sponsor. These are essentially the shares that the founders or early investors get. In their case, the sponsor received over 12 million of these shares for just $25,000, which is a pretty sweet deal for them. This was recorded as $25,000 in additional paid-in capital. It's like an initial investment from the sponsor to get things rolling, and that's how you see a positive $25,000 in the statement of changes in shareholders' deficit. When we look at their cash flow, it's pretty straightforward. Their net cash used in operating activities was zero. Remember, they weren't operating yet. The only cash movement was from financing activities. They brought in $25,000 from issuing those Class B shares to the sponsor. So their cash at the end of the period was $25,000. This next part is really important because it talks about how these companies work once they go public. The company's Class A ordinary shares, which are the ones that will be available to the public, are subject to redemption. This means that if shareholders don't like the business the company eventually merges with, they have the option to sell their shares back to the company for their original purchase price. The report mentions specific dates like August 1st and August 13th, 2025, which are crucial here. These are the dates around their initial public offering. For instance, on August 1st, 2025, they had $250 million in Class A ordinary shares subject to redemption. Later on August 13th, after some underwriters exercised their options, this grew to $280 million in Class A ordinary shares subject to redemption. Later on August 13th, after some underwriters exercised their options, this grew to $180 million in Class A ordinary shares subject to redemption. Later on August 13th, after some underwriters exercised their options, this grew to $280 million in Class A ordinary shares subject to redemption. Later on August 13th, after some underwriters exercised their options, this grew to $280 million. This highlights the significant amount of money raised that's essentially held in trust, waiting for a business combination. Now let's quickly touch upon their accounting policies. They're an emerging growth company, which gives them some flexibility on certain reporting rules. They're also electing to use extended transition periods for new accounting standards. This isn't to hide anything, but rather to align with how private companies adopt these standards, which can make comparisons with other public companies a bit tricky. They also detail their offering costs, which are pretty substantial. These are the expenses directly tied to getting the IPO done. They spent over $3.5 million on this, with a big chunk allocated to what they call representative shares. On taxes, they're based in the British Virgin Islands, and as of this report, they weren't subject to income taxes there or in the US, so their tax provision was basically zero. Then there are the warrants. These are like coupons that give the holder the right to buy company shares at a certain price later on. They accounted for both public warrants and private warrants here. This section re-emphasizes that Class A shares are redeemable, meaning shareholders can get their money back if they're not happy with the future merger. It shows how the money is allocated between shares and warrants and how they account for expenses related to the IPO. Because they're not making any profit yet, their net loss per share is 0. This is normal for companies in this pre-operational phase. Here's where it gets interesting with fair value. They're valuing some of their financial instruments, like this over-allotment liability. They use complex models like Black-Scholes and Monte Carlo simulations, which are basically sophisticated ways to guess the future value of things like warrants. The fair value of those public warrants, for example, was estimated at over $8 million. So what's the story here? Boral ARK Acquisition Corp is in its very nascent stage, focused entirely on preparing for its IPO and finding a suitable business to merge with. They've raised capital, structured their initial stock, and are awaiting the crucial next steps. The management discussion section echoes this, stating they haven't generated revenue and are all about the business combination. They anticipate increasing costs as a public company and acknowledge the risks involved in finding a target business. Crucially, they highlight that many statements in the report are forward-looking. This means they're predictions about the future, and as we all know, the future can be unpredictable. They are being upfront about the uncertainties and risks associated with their strategy. Their liquidity at the end of June was minimal in their operating accounts, but the bulk of their funds were set aside in a trust account, which is standard practice for SPACs. They've also secured loans from their sponsor and plan to use funds outside the trust account for vetting potential merger targets. They expect to have enough funds to operate for at least a year, but that all hinges on successfully completing their business combination. The management discussion reiterates they are a blank check company focused on a business combination. They went public raising $250 million initially with the potential for more from underwriters' options. What's interesting is their timeline. They have about 18 months with a possible extension to find a business to merge with, or they face liquidation. This creates a sense of urgency. They've also confirmed their disclosure controls and procedures are effective, meaning they have systems in place to ensure their public reporting is accurate and timely. No changes to their internal controls were noted during this period. Under other information, they state there are no legal proceedings against them. Importantly, as a smaller reporting company, they're not required to detail risk factors in this specific report, but they do point to their IPO prospectus for those. They also mention that as a blank check company with no operations, they aren't directly facing cybersecurity threats themselves, but rely on third-party providers. Now let's look at the bigger picture for D, Boral ARK Acquisition Corp. Their strategy is clear, IPO and then acquire. The key numbers here are the significant funds raised, over $250 million held in trust, and the clock ticking on their 18-month window to find a business. The fact that they are a blank check company means their financial health isn't really about operational performance yet, but about their ability to execute their merger. The sponsor's initial investment in shares are also a key factor in their early structure. The biggest risk is failing to find and complete a business combination within their time frame, which would lead to liquidation. This makes their due diligence and deal-making capabilities paramount. The opportunity clearly lies in successfully identifying and merging with a promising company that can leverage their capital and public listing. In conclusion, D Boral ARK Acquisition Corp is in its starting blocks. They've successfully launched their IPO and are now in the critical phase of identifying a target. Their financial status is essentially a holding pattern of raised capital. The real story will unfold in the coming months as they pursue their business combination. What's your take on this SPAC strategy and their chances of success? Let us know in the comments. If you found this deep dive valuable, please hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community for more exclusive insights. Thanks for watching, and we'll see you next time.